Hey, good evening. Thank you all for joining us tonight. It is good to have you here. As always, the dental M&A markets are an ever-moving, ever-evolving target. First things first, there's an election brewing, if you haven't heard. If you haven't been following the news, we're right here on the heels of it, and we wanted to talk through what that could potentially mean to the U.S. economy and to practice valuations on a go-forward basis. We also want to spend a little bit of time talking about risk and the changing market and how it's perceiving that risk, especially on what we'll call the enterprise level DSO. Because right now there are two distinct markets with different forces at work. Let's say over $40 million of EBITDA is facing unique challenges and unique forces at work, and less than 40 million is facing its own set of unique issues. And again, happy you all are here this evening. As a reminder, feel free to drop any questions you have into the chat. We will absolutely get to those. If we don't get to them this evening, we will get back to you within 24 hours. So thanks so much for joining us. And Ron, let's go ahead and kick this off. So joined tonight by Ryan Mingus, Managing Director at TUSK. And he's really, on the forefront of everything dental M&A. But we'll just do a quick overview of who we are for those of you who are new to TUSK Practice Sales. I'm Kevin Cumbus, President and Founder, and joined with me tonight is Ryan Mingus, Managing Director, who leads all of the dental efforts inside of TUSK Partners.
Yeah, thanks, Kevin. Happy to be back at it again. Looking forward to a great evening.
Yeah, me too. Me too. So TUSK, the team, 14 team members scattered throughout the U.S., done well over $1 billion of dental transactions, 40 years of experience in dental, over 50 years of experience in private equity. I really think that's what makes us unique, is that it's not just born and bred in dental. I think the next slide really does a great job of explaining that. On the left-hand side here, you see all the companies that our team has worked with and for inside of investment banking, private equity, mergers and acquisitions, and finance. And it is a stellar collection of organizations. This is really where our team cut their teeth on practice valuation, M&A processes, quality of earnings, working with private equity companies. I mean, decades of experience here that we marry with the right side of the page that are all of the dental businesses that our team has worked with and inside of. We have former CEOs, COOs, business development team members. And what's so lovely about that is they know the way the buy side thinks. And we're able to harness and leverage that knowledge to the great benefit of our clients. And it's fun for them to be on the other side of the table and tell us, man, I finally feel like I'm working for good here. I know that I'm doing everything in my power to maximize the value for our client rather than just try to win points and get a deal closed for my boss, the DSO. So anyway, so in between those two worlds is really where TUSK lives, and we continue to strengthen and bolster the team and talent with each new hire.
Great. Thanks, Kevin.
So we can't go to the dental economy until we spend a little bit of time on the U.S. economy. So there are really four key drivers of the U.S. economy that impact the dental economy that I want to spend a little bit of time with. You've seen these before, but they're worth going to again because of how they work on one another, are married to each other, and ultimately how they impact the operations inside of your dental business and the valuation and exit value of your business moving forward. So first things first, Fed funds rate. This has been a saga, right? If you listen to the talking heads, we were supposed to have a rate cut by now. But the Fed, every time they meet, they say, well, not just quite yet, right? So they've actually changed their tone pretty sizably from where they ended Q4 of last year. Right now, there is an expectation that we might be flat through the end of the year, and they have reserved the right to actually raise the rates if we can't get inflation under control. The cost of living, the cost of your mortgage, the cost of your automobile, it has all gone up. And I think what we see is a general sentiment in the market that My dollar's just not going as far as it used to because of all the interest rate expenses as the interest rate has gone up. Well, the way you feel is the same way DSOs feel. They have a lot of debt on their balance sheet as well, and the cost of that capital keeps increasing. A lot of the debt they have today is variable rate debt, right? So the higher the interest rate goes, the more expensive it gets from a cash flow perspective. And there's a expectation, hope that this will begin to come down. Just keep in mind that when a lot of these businesses were built, they were formed back in 2016, 2020, 2021, and there was a general expectation, erroneously, that rates were going to kind of stay where they were. And to see this massive hike since the middle of 2022, it has severely impacted their ability to grow and get additional financing for acquisition capital. That, coupled with the unemployment rate being as low as it is today, right now we're hovering a little south of 4%. The job market's thin, right? So during COVID, we had the Great Resignation. Then we have like this wage inflation that is continuing to impact certain markets, and the cost of dental labor was materially impacted, right? Healthcare was almost the hardest hit sector of all sectors out there when it came to the Great Resignation. So we've got costs going up, we have acquisition costs going up, and if we look at the next slide, let me show you two other things that we monitor on a regular basis.
Yeah, just tapping on the interest rate thing before we advance, Kevin, like to go to your point where when these businesses were formed, a lot of these DSOs 16, 17, like it's not just that it went up a couple percentage points, it went up 300%. So it's like a double or tripling of interest rates. So you don't get caught up on, oh, the interest rates used to be 1.5% or 2%, and now they're 5%. Like the amount of impact that has on their models is profound, and their ability and the bank's ability to continue to loan to these businesses to grow through mergers and acquisitions is incredibly hindered. So it's kind of, sometimes it gets lost and you just think about the percentage point increase, but really if you take a step back and it's a 300% increase in the cost of debt, like that has a profound impact on these groups, that we'll kind of discuss what that ultimately means for them.
Yeah, thanks for calling that out. And also, nobody is getting acquisition debt at 5.25%, right? Their cost of capital is 9, 10, 11, 12%. So it is much higher, double, triple what it was just a year and a half ago.
Yep.
All right, so household debt. This is something that I've been watching really closely because this is the largest amount of debt U.S. consumers have ever carried. Yes, a large part of that is housing debt, but another sizable portion of that, the red portion there, is really credit card debt and automobile debt. We are reaching a point here where credit cards are tapped out. Interest rates on these credit cards are going to go to 22, 23%, and the spending is over. I mean, when the government during COVID started issuing checks and shooting the money cannon out, and everybody was feeling flush with cash, they just wanted those good times to keep going, and they leaned on their credit cards. Well, now they're at a point where credit scores aren't where they need to be, in many cases, to get financing of large cases done. Thankfully, there's other companies that are willing to go to the subprime market to help dentists and specialists get large cases done. But if you're a business owner who's relied on Care Credit over the years, it's likely Care Credit's going to start declining some of these folks. And you're going to have to go to a subprime lender in order to get that done. And that inserts a whole different layer of risk into the income statement of your business. We got to rein in the spending here. The party is over. So let's act like it and be adults here and start paying off our credit card bills. On the inflation side, when most recently when the Fed met, there were some relatively negative inflation numbers, meaning that the cost of goods have continued to go up for all of us here in the U.S. And that's what tempered them into not cutting rates. We did have some fairly decent news recently, but on the balance, what the Fed is targeting is really a 2% CPI. That's where they want to get is a 2% CPI inflation rate. And when we get there, I think that's when they will begin to start cutting the rates, if not before. If they see a pathway to that, that's what they'll get to. What this graph does not show, though, is the impact of all that interest we've been talking about, right? The interest on your home, your automobile, and some studies that were done out of DC recently say that if you include the cost of financing, that this is actually a lot closer to 18% than the, let's call it 4% you see here on the far right side of this graph. So I think there's a general growing concern that the dollar is not going as far. My personal costs are higher than they have been, and maybe, hopefully, some belt tightening is around the corner. Anything else to add, Ryan?
No, I just think that that's an incredibly important call out as more and more of Americans in particular rely on credit cards and some of these fintech companies, like you mentioned, subprime, like you can finance anything now currently. So that red that's on the left in terms of the non-housing debt, the things that you can now finance and the willingness of organizations to allow you to do that is incredible. And I think everybody, the majority of America is, managing a monthly budget. And when that inflationary environment starts going up, it kind of has a compounding effect that is certainly worrisome, but also important to always look a layer deeper, like you did, in adding in that interest rate to that number. As we're trying to pull out our crystal ball here, later and talk about what's to be expected, or what should we be looking for the end of the year and into next year.
Right. So the title of this is ballot proofing your practice. So we got to hit on what's going on with this presidential election. There is no clear front runner here, and we all know by now that the market and investors really don't like risk and uncertainty. And it is absolutely the case where there is billions of dollars sitting on the sidelines until we know who our next president is. So and those dollars can understand and appreciate, be it Biden or Trump. Either way, the dollars are going to flow. They're going to flow somewhere depending on who the president is, but they are pinned up waiting until they know who's going to be in charge of our executive function going forward. We've seen this before, right? And what we typically see is once the president has been elected and selected, money begins to flood into private investments and public investments. But until that date, until the president is known, we are effectively in a holding pattern for a large chunk of cash. The other piece of this is each of these candidates brings very different policies with them, extremely different policies with respect to tax and operations, with respect to the enforcement of non-competes, all the things that us as business owners are very focused on and believe could impact practice valuation on a go-forward basis.
Yeah, it's not the greatest situation to be in for the line of work that we're in. We live in at the mercy of the folks with the checkbooks, right? But I guess the quicker we can get to the election and or certainty on who the winner is going to be, I think the better we're all going to be for it. So lucky for us, that is a finite amount of time that we have to wait.
Yeah, there's a countdown clock in the office. We keep waiting for it to occur.
Yeah.
All right, so my father told me a long time ago, the only two things that are certain in life are death and taxes. So we got to touch on those. Biden is doing it again. He is standing behind his tax package that he tried to get passed when he was most recently elected, looking to increase ordinary income tax rates, most notably long-term capital gains rates, almost doubling those. And for those that are high income earners, almost up to 45%. I want to double click on this one because this is most important for anyone who's thinking about selling their business. So when you sell a business, you sell it for a number, right? And that number is defined as enterprise value. And that enterprise value is then allocated across two distinct asset classes. One of those asset classes is fixed assets. That's kind of everything in the practice that you can see and touch and feel. And then the second allocation is to intangible assets. And that's all the goodwill you've created inside of the business since inception or since you bought it. And the way these businesses trade at a multiple of EBITDA, um, and every time we work with clients, we're able to negotiate those fixed assets, the allocation of fixed assets down to somewhere between 5 to 10%. And that's a good thing because the tax on that portion of the enterprise value is taxed at ordinary income tax rates. And the portion allocated to intangible assets, typically between 90 to 95%, is taxed at long-term capital gains rates, today close to 20%. If this long-term capital gains tax hike goes into effect, the allocation of the purchase price surely doesn't matter as much, and the incentive to sell really isn't as strong as it once was, right? Because when you sell your business, think about taking EBITDA, the free cash flow from the business, and the multiple is the number of years you get to enjoy it. But one of the big benefits of selling is most of that enterprise value, the EBITDA times the number of years that you're going to sell it for, is realized at long-term capital gains rate. If this benefit goes away, it could really create major headwinds for anyone thinking about selling their business. It would really put a chokehold on the M&A market because at some point it's just not worth it to sell.
Yeah,
We've seen this rhetoric before.
yeah, it's essentially going, blended rate of anywhere between 23 to 26.5% to 30, call it 40%. So, I mean, it's almost doubling of when you take the two blended rates and compare them.
Yeah, I mean, so there's in previous years, well, I guess during the last election, we saw a rush of business owners say, listen, it's too much of a risk for me to take on. I'm going to go ahead and get out before Biden could get in office and put any tax changes in. As a result, it drove volume in the M&A markets in a way we had never seen before. And there was so much volume that both the attorneys and the accounting firms that do the quality of earnings shut their window. And they said, look, we can't take on any more deals. We're going to have to push that deal to next year. Thankfully, we've got great relationships with the attorneys and the QV firms, and all of our deals closed. But in that year, we closed, I think, 6 transactions on 12/31 itself. So there will be a rush to get deals done if those polling numbers start to change. And there is any likelihood that Biden's going to do exactly what he said he would like to do.
Right, right.
All right. So the other thing that is slated to occur is there's about to be a sunset on a pretty interesting wealth transfer opportunity that exists today. So back in 2017, the Tax Cut and Jobs Act, the TCJA, created a new extended lifetime exemption for individuals giving to their children, right? So it rose it from 5.6 million to 11.18 per individual index for inflation. All right, well, today in 2024, that exemption is up to north of 13.5 million bucks. If Congress doesn't do anything, at the end of 2025, the end of next year, this exemption reverts back to the levels it was at before the Tax Cuts and Jobs Act was instated. So it's back to 5.6 million. We are working with a sizable number of extremely wealthy individuals with large businesses to create, I would say, tax savings vehicles in preparation for the exit of their business. There are legal, clear-cut ways to do this. It does require time. It does require energy. It requires some accounting and legal work, but there are certainly ways to mitigate this risk that we certainly believe is coming. Look, the government's got a huge deficit, and they have to solve for it some way, somehow. And I think this and the Biden tax plan are 2 ways they're planning on doing it.
Yeah, just double tapping. You said it, but want to beat everybody over the head with it. It takes time to set these trusts up or all these different things that need to take place. businesses that need to get set up, entities that might need to get set up, legal structures of the business, et cetera, et cetera, et cetera. There are a lot of moving parts in order to maximize, and it requires a lot of planning and a lot of coordination. And certain things need to be done in certain calendar years. So you might need to be, getting something done this year in order to make sure that you're eligible for the benefit in 2025 or, and what have you. So I think, we've got a number of resources in our network that are experts in this, and certainly encourage folks to reach out and start a conversation as early as humanly possible if you live in this world where you're going to have this much cash to pass along potentially to the next generation.
Yeah, we've been talking with some financial planners about this and with trust attorneys about this, and they fully expect to be overwhelmed, call it the second, third, and fourth quarter of 2025. So if this is something you're considering, you do need to move pretty quickly on it. All right, so we've covered the broader U.S. economy, taxes, and death. Let's dig a little deeper and we'll take a scope into the dental market. I alluded to this earlier. It's really a two distinct markets that we're seeing right now, and I get into arguments with our friend Brian Kaleo over at Dicom about this because, I think he works a lot in this over $40 million of EBITDA world. And when I call him, it's not a great conversation. He is feeling and sensing everything we've laid out here on this page, and it really starts with that graph on the upper left-hand side. So this is from PitchBook. These are healthcare services that private equity companies have exited by type, right? So how many deals have they actually exited this year? Well, it has been slim pickings. There have been a lot of failed deals. There have been unmatched expectations between the seller and the buyer around price, where the seller has an expectation that they're going to sell their business at 14 times and get 3 times cash on cash return for their equity holders, and the buyers say there's no way I'm buying that business for that. Not in this market, not with this cost of capital that I would need to finance the cash portion through debt financing. So the volume at this level of the market has been really, really low. And again, keep in mind, these are just healthcare businesses. We'll look at an example in a minute, but Ryan, I think you were sharing with me, I mean, there have been 10 large-scale DSO deals we know of in the last 18 months that simply did not get done. Got close to the finish line, but for one reason or another, sometimes retrade, sometimes capital, lack of capital, sometimes change of hearts. They just didn't get done.
And those are the ones that actually went to market. There's track record of them pursuing a suitor. It does not show how many were advised by their investment bank to not even attempt to go to market, because what you're saying you need or your board needs is not achievable in today's marketplace for the asset you plan on taking to market. So the number's probably a whole lot higher than 10.
Yeah, you're right. Yeah, nobody beats their chest at the bar about their failed deals, do they? All right, so we try to pull together this so you get a handle on what we're seeing in the space. So right now, there's that big orange circle represents one deal that we are well aware of that has been going through a process. And although they are close to getting a deal done and completing a recapitalization with a new private equity sponsor, they haven't done it yet. And this is a DSO that we believe will really set the new mark once this valuation hits the tape. No word on where it possibly could trade, but it's such a big such a big deal that there's all these other deals kind of standing in line behind it. When this deal gets completed, they're going to be a ready buyer for businesses because they have to grow in order to meet shareholder expectation, and that's great. But all these other deals that are in line waiting to get done will quickly follow, because that will be the sign that the buy side is there. We have a new expectation around valuation, and it will be. We thought this would be coming in Q4 of this year. We might begin to see this happen. I think there's a decent likelihood that big trade gets done. And if it does, expect the floodgates to open and see many, many, many more of these deals come through. Then there are the failed deals that we've already mentioned. They will be jumping back in the basket again and trying to get through the funnel so they can get a fresh stack of capital and continue to grow their businesses.
Yeah, it's really interesting to just kind of see all the dominoes getting lined up. And we have these conversations with buy side all day, every day. Some groups that are just forming, some groups that have been around, have been through multiple recaps, other groups that are trying to get through their first recap event. Being constantly on the phone with these groups and hearing as they're pitching our clients on their respective timelines, they're kind of all parroting one another that kind of line this up really well. And hopefully we can see multiple recaps by the end of this year, one being the large one, but we also know of quite a few kind of mid-size, perhaps below $40 million of EBITDA get their deal done as well.
Yeah. Yeah, it's going to get exciting when that one gets done. All right, let's talk about the lower end of the market, less than $40 million of EBITDA. There's actually large volume of deal flow here, especially in, let's call it, the $1 million to $10 million of EBITDA. We're seeing, a lot more opportunities. I think some of that is led a little bit by fatigue by the doctor owner group that had aspirations of having, 3-4 million, getting to 2 and saying this operating environment's gotten hard. And I really do want a capital partner to help me get through it and to help me grow, right? So these deals are not just exits. They're opportunities for you to connect with a bigger balance sheet and a great operating team and roll equity and reach that moment of transformational wealth just with someone else's help. The interest rates that have been rising have made the buyers think about structure a lot more. Dentists and everyone on this call in particular is dialed in on understanding what a multiple is, right? And everyone wants to sell for a multiple. There's emotional attachment to that multiple. So they're finding ways to ensure that they hit the multiple by structuring the deal differently. 2 years ago, it was very common to see deals at 80% cash at close and 20% equity roll. Today, we see them anywhere between 51% cash at close and 70% cash at close. But the deals of the days of an 80-20 deal feel pretty far away from us right now. So creative deal structuring to get deals done and really doctor sellers getting comfortable with that because they do see a growth story, they see an opportunity, they just need somebody else's balance sheet, and frankly, they're just tired of personally guaranteeing the debt and being the lone person in charge. Anything else to add here?
No, I think that's it. It's just interesting, like how acutely aware the sell side has become to multiples, and how the buy side has changed the way that they pitch their deals. Call it 2 years ago, leading with multiples, whereas 10 years, 5 years before that, it was never referenced in their LOIs. So seeing the change in deal structure in an effort for them to account and I guess help sellers feel comfortable that they're receiving a multiple that is what they had in mind when selling their business is kind of interesting. And we've had plenty of clients prefer a slightly lower multiple because the structure was more advantageous to them and it put less risk in their world, and more cash in their pocket at close. So that's something of note, that an 80-20 deal might be achievable today, but it's at a realistic multiple that is indicative of the current interest rate environment and the amount of debt that they're able to put on a business. But it's not just about the multiple, as we always say, it's always about the structure. And it just continues. I think that we're doing more work in a good way on behalf of our clients to help them understand the vast difference in structures that are available out there right now.
Yeah, just to give you a sense of that, we've got a deal in market right now. IOIs were due, and just to give you two real examples here. So $2.5 million of EBITDA. IOIs came in at 9 times by both DSOs. One of the DSOs is 60% cash, 40% equity on that 9 times 2.5. And then on top of that, there's an opportunity to make even more with a true up on EBITDA growth over the next 24 months. Okay, so that's one offer, not too shabby. The other one was 2.5 times 9 at 40% cash, 30% rolled equity, 20% earnout, and a 10% seller note. The difference between those two offers is vast. And in offer number two, you've got all these dollars at risk. So you really got to pay attention to this allocation and where are the buyers trying to put the risk? Are they willing to actually take some on? Are they really trying to buy the business, own it completely, and control it while you maintain most of the risk?
Yep. Yeah, it's been crazy to see what's coming across the wire. I know everybody's got to do what they've got to do, but it makes for some interesting modeling for our clients, which is fun.
Yeah. All right. So the great news, look, on the deals that we choose to represent, we're still getting multiple offers in extremely competitive processes. So we feel really good about the deals we are representing and getting closed. And the buyers are more plentiful this quarter than they were last quarter. So I feel like the buy side is coming back, and that's really, really good news. Multiples are still strong. There's seemingly not enough $1 to $6 million EBITDA deals to meet demand, because every time we take one of those to market, I mean, it's like the whole market wakes up. Less than $1 million of EBITDA, there's a sizable number of those, but this 1 to 6 million of EBITDA feels like an area where demand is high and supply is low. And when you have those two dynamics at work, you got a lot of competition, and valuation goes up because of that competition.
I would also say the least number of boxes or dots on a map that it takes to get to that 1 to 6, the better. All these groups are worried about integration risk, and the more cultures that they have to absorb, the less excited they are about the opportunity. So it's not just about the size of the EBITDA, but it's also like, how is it concentrated as to the range of multiples a group's willing to put out there for you.
Yeah. So the headwinds or the challenges right now, and a lot of this is coming from the larger enterprise groups, like north of $40 million of EBITDA that have had failed processes or are working with investment bankers and hearing what the market wants to see. They want to see a growth story. They want to see growth in four-wall EBITDA, not just top-line revenue. You really got to show growth at the operational level. Because the days of stacking EBITDA and trying to flip that out to an uninformed private equity investor are all but over.
Yeah.
Well, there have been,
if you want to, anybody that's worth their salt these days is seeing right through any of those assets.
Yeah, I mean, this is why many buyers just went pencils down for a while, right? They're like, okay, we've been told by the market, we got to button this up. We're going to hire the right people. We're going to focus on the right things. We're going to build the infrastructure that's going to enable us to actually grow same-store sales before we do another acquisition. Because what's the point in stacking EBITDA if we're not going to get paid for it?
Right.
There have been a series of failed consulting roll-ups. I think that anytime there's a lot of money sloshing around in industry, people think that they can make money in it. Unfortunately, we've seen a lot of these deals fail. A lot of doctors commit their businesses to them and ultimately not able to get done. Connecting one of your practices to a group where you lose control and you put all your faith and confidence in someone who has never done this before is risky business. I don't think this wave is over. I think we're going to see more of this when the market recovers, but we've seen a lot of these fail recently.
Yep.
And then finally, there are still bad actors out there. There are a series of DSOs we do not show deals to. We will not show deals to. They misrepresent themselves, they overpromise and underdeliver. They're not capitalized. They'll present themselves as private equity when in fact they're a search fund without committed capital. They will chew up time, energy, and emotions. And then there are some DSOs out there that we simply know will not make it. So you got to be careful who you're partnering with right now. It is dangerous times out there to be doing your own deal.
Yep. Great segue into the next. So I want to go deep dive into dental specific, as that's where everyone on this call is focusing all of your time, energy, and resources. So ultimately, takeaways are that currently 40% of all legacy DSOs are still not active. What we mean by legacy is those groups that have been around perhaps through multiple recaps already, but at least one recap at minimum in order to be kind of classified as a legacy DSO. But they are focused on those things that Kevin mentioned, which is addressing all of the operational headwinds that they're facing with respect to wage inflation, supply inflation, and focusing on same store, not just revenue growth, but EBITDA growth. And in order to grow EBITDA, you need to both focus on the top line of maybe payer negotiations or marketing efforts to drive more patient volume to your businesses, but also on expense management to make sure that we're protecting the margin on all those dollars that we're going out there and adding to the top of the funnel. Legacy DSO, these folks are on notice. There were those 10 failed transactions that we talked about, a myriad of others that probably never went to market. And that has certainly spooked some investment committees around what they're able to put forth on a go-forward basis with respect to leverage that they're putting on their deals, which is why you're rather than see a decrease in multiple, you're just seeing a shift in the amount of cash at close that they're willing to put on a deal based on their historical offers, because of the leverage that they don't want to put on the business as per their investment committee and or the bank that's lending them that debt. So they're on notice, and the offers that they're putting forward are reflective of that, and it comes through in a couple forms. One, in the actual offer that they're putting out there. Two, the structure, and then three, the volume of deals that they're even looking at.
Yeah.
They have a much tighter target acquisition profile right now, and if it's not middle of the fairway, low risk, they're just not even going to take a run at it. And that is certainly not the case in years past. So we have thankfully had, as the dental world did prove to be pandemic resistant after years of recession resistance, DSO, private equity groups still continue to want to get their initial investment in the dental space and get their first DSO platform out there. It's not uncommon for a private equity group to look at 300 deals and do one. And it might take them 2 or 3 years to find that deal that they feel comfortable with. And lucky for us, we've had the good fortune to know these groups as they get formed. We've been fortunate enough to be the representative of the client that ultimately formed a new DSO in recent years. So as such, we know who they are and have been able to put our clients in front of this new pool of buyers. But that doesn't come without challenge. So groups that have not been around and had as many reps as a legacy DSO, well, every little thing spooks them, for one. So loss of an associate would send alarms all through the hallways of that organization. So their risk tolerance is much lower. Their deal acumen is much lower. Not to say that they aren't smart people, but they just haven't had enough reps to really know how to navigate these waters and have difficult conversations at time. A lot of times they're just kicking the can and waiting rather than addressing something head on, which is always going to drag things out further. And the longer you drag things out, time kills all deals, and the likelihood of you getting that deal closed is much less. So thankful to have them in the world, but you really need someone like TUSK that helps drive the process and manage all of the different stakeholders effectively and run interference when necessary to make sure that these deals get done. We're kind of greasing the wheels, if you will, to make sure that this thing runs as smoothly as possible, because quite frankly, we've got more reps at this than the buyers in many cases.
Ron, one thing we're seeing right now in recent weeks with some of the new deals, larger deals we have in market, is private equity groups that have an existing platform. Maybe it's in a unique specialty, and we're showing them something in a different specialty, a different geography, and they're seriously contemplating building a new DSO. like saying, listen, this one's going well. We appreciate it. We enjoy it. We like the space. We like the profitability. We understand it now. And we want to take those learnings into our next platform. And we love working with those private equity groups because they do have a sense of how to operate in many cases. In some cases, they've already exited their inaugural platform and returned dollars to investors. So that's really why we're continually talking with not just the DSOs, but the private equity companies that back these businesses.
Yep, well said. This is certainly, I would say kind of new, right? Fit matters more than ever. Private equity groups used to be comfortable stacking a whole bunch of practices together, stacking EBITDA, paying a double-digit multiple, and going about their business, getting the deal closed, racing to the finish line. That is not the case anymore. Fit matters more than ever. Good buyers are not just interested in the EBITDA. They really need to understand the story behind it, the strategic rationale for why they need to stretch on valuation and how they can sell that internally to their investment committees. If you want to get top dollar. And that's where, TUSK comes in on a multiple fronts. One, we help you look at the business. We assess the business. We work with you to understand where the growth lives in that business. And then as we're talking to these buyers, we know what muscles they have and what they're good at. And we know how to frame your business in such a way that is going to help them understand how 1 + 1 = 3 for your business, their business, and the ultimate outcome. So there are so many different ways that we can tell that story. And it really is exciting to work with our clients prior to going to market to really understand, hey, if I gave you $50 million, what would you do with it inside your business? And letting our clients tell us, and then finding a way to craft that story and highlight those elements to the buy side. And then secondarily, in addition to us in the storytelling and the pitch book development, but also it's going broadly. That's really the only way that you can ensure that you see every single potential suitor out there for your business. And it is a lot of the time about timing and you being the right group at the right time for the right buyer. It ultimately allows for a higher or above market multiple to be applied to your business. And that means going as many as, we might have as many as 50 initial phone calls on any given deal that we take to market in order to vet that pool of potential buyers down on behalf of our clients. So we're going out there doing the legwork. We love doing it. We're having these conversations. Oftentimes it might not lead to an opportunity for your deal, but it might lead to some other business that we're representing. So we love doing the work, and we also love seeing the results that it yields.
Yeah, one of the cool things about that process is, you're going broad, you're having 50 conversations. Meanwhile, your client is operating and managing their business, and you're trying to separate who the tire kickers are from the ones that are serious with capital that are ready to get a deal done. You're pressing them for, indication of interest or a letter of intent. We are working with them on the diligence side, getting them spun up to speed on the model, the add backs, where the opportunity lives in the business. And meanwhile, our client is continuing to operate their business the way he or she should. And really, only when it comes time for a conversation that we know will propel the LOI further and extract more value, then and only then do we really lean on the client then and take some of their time away from the business so we can leverage that in meaningful ways and enhance value.
Correct. So we kind of covered where the market is. It's important for us to pull out the crystal ball and kind of see where the market's going by reading some of the tea leaves. So that's what we're going to do here. Starting with the tailwinds, the things that are, we're excited about, data points that we're excited about that ultimately can help us understand what the rest of the year is going to look like and ultimately 2025 as well in our world. So DSOs have been actively securing fresh credit facilities for the last 2 years. So starting in the second half of 22 on the left side of the graph, and then the first half of 23, $320 million across 2 DSOs. And then this huge jump in the second half of 2023, whereby 2 very large DSOs went out and secured 2 very large credit facilities in an effort to bolster their M&A and acquisition strategy to get to their next recapitalization event. So these are groups that are likely trying to sprint to the finish line or stacking up a lot of capital because they had really preferable access to affordable debt that, you know, they couldn't say no to. And they thought it was good to lock that in at this juncture and then sit on it until the market kind of opens up, call it after the election, and really have a heyday of things. That being said, they still need to put that to work in the near term, but you know, they're sitting in a very good position for when the market opens up.
Yeah, I want to add a couple things here. Um, you know, there are a lot of we call these companies zombie DSOs, businesses that were really large, had acquired a lot of dental practices, but had run out of credit, right? Ran out of debt and couldn't grow through acquisition. They were in breach of covenant with their lender or technical default, and they could neither grow through acquisition or get really good at right sizing expenses in the organization and grow same store sales. Those businesses are going to be really hard to sell. They got a lot of work ahead of them. And there were some businesses that went to market because they had to. They'd run out of debt financing. And when they got to the negotiating table, their best alternative to a negotiated deal wasn't that great, right? So maybe they had to accept a multiple that wasn't as savory as they had hoped. Ryan mentioned this, but it's worth repeating. Uh, they want to stack their balance sheet with available credit, so when they go to market, they have an alternative to doing a deal. They can continue as business as usual. So we've been asked a lot from our clients, "Hey, the DSO I'm connected with just got a new credit facility. Is this good or bad?" It's great. This is a wonderful thing and gives them operating flexibility for the future, and likely means they're closing in on a recap.
Yeah, and then it continued on into early 24, and I expect there to be, you know, hopefully more coming in 24 as these groups prepare for, you know, the post-election era. But yeah, it was over 1.8 billion over the last 2 years, that's a great signal for our world. And you know, think it's important to mention. So some of the headwinds, none of this is going to come as a surprise to you because you're living it, and we've also touched on it already. But starting with sort of the macro M&A, what are interest rates going to do? Are we going to get a cut? Are we going to get two cuts? Are we going to be flat, or are they potentially going to go up? Keeping a close eye on inflation, how that's going to CPI that Kevin mentioned, but also looking at it, you know, through other lenses, layering interest rates, et cetera. To help get an idea of where things are going. Debt markets, bank versus private credit. There's been a lot of these private equity groups started offering, you know, private credit options to groups out there, not just in the dental space, but all throughout business. Private equity groups started, you know, using their dry powder in a way that it was not initially raised, but at the same time, they needed to put that powder to work. So they got creative as well. And it'll be interesting to know, like, whether, you know, the bank debt or the credit markets end up, you know, kind of leading the pack as things go forward, because it has traditionally been banks, but it's possible that through this environment, banks get displaced as sort of the primary option for these private equity groups that are going out there trying to grow. The tax changes, both, you know, kind of personal and estate, or capital gains in estate, and potentially to personal income tax as well. That's something that we're based on the amount of debt that our country takes on an annual basis. At some point, there has to be some level of addressing that, and taxes might be the way that ends up going. Just a matter of whether those are corporate taxes, personal taxes, capital gains, estate, et cetera. And then the operating environment, you guys are living it each and every day. Hopefully there's a leveling out of wage inflation for key personnel in dental practices and otherwise, but the operating environment continues to be tough, and you know, certainly something that everybody has to be cognizant of if they decide to hold and grow in this difficult environment, or whether they want to opt to go to market in the near term and kind of secure their chips while they've got them.
Yeah.
In the dental space, So on the deal front, the structures are changing, and that's certainly a headwind for some of our clients to get comfortable with or accept, because it's possible they, educated themselves on what the market would give them 2 years ago, and they opted to hold and grow. Well, now they're going to have to come to terms with the new structures, and the new valuations. The third bullet, they're going to have to get comfortable with perhaps a gap from where they thought they would be selling their business from a multiple and from a deal structure perspective, as they were doing their internal planning for retirement. If they knew that they had a number that they needed to hit out of the cash at close number, well, now they've got to layer in all the environmental changes from, perhaps an EBITDA erosion perspective, plus multiples being slightly less favorable, plus deal structure being slightly less favorable, and that ultimately creates that bid-ask spread that we're talking about here. So we always think it's important for clients, before they make a decision to go or not go to market, is to kind of do that forecasting of what they need to do for their business in the time period that they need to do it, in order to yield the outcome that they are excited about, and whether they want to bear that operating risk in the meantime. Greater scrutiny from the buy side, the fit matters. That's where the storytelling comes into play. That's why seeing every single potential suitor in the market is paramount. And that's where really we feel that we excel, because we go broader than everyone else, and we're willing to get to know what's most important to our clients and fight for those things. Struggling large DSOs are going to continue to be some headwinds that we have to navigate. Ultimately, what that means to the market from a signal perspective, but also those large DSOs not being buyers, and what that means if they never come back to being a buyer, or they take 3 years off instead of 1 year off. Focus on EBITDA growth. That's certainly not the top line like I mentioned before, but it's pure operations improvement in your business to make sure that you're fighting for same store EBITDA sales across all your locations. And having that to go to market is a really powerful example. And looking back on Q1, there were some early positive signs. So there were some DSOs that have re-entered the market. There are some DSOs that have been retooling their business development team. One thing that we didn't really touch on is that when we say that 40% of the legacy DSOs went pencils down, that also means that they likely laid off their entire business development teams, and they're not just going to keep them on payroll. Rather, when they go pencils down, that's a full commitment to at least 12 months. And then they will actually go out and rehire a team, and that comes with its own challenges and onboarding and ramp up. And then you got DSOs, new credit facilities. We touched on that. New private equity groups are looking into the market. We take calls on a daily basis of groups that are still trying to get that first investment, and we continue to show them opportunities that we have to help get them into the space. We absolutely know that there are groups expecting to get their deal done in 2024, and we are cheering for those and hoping that they get the highest multiples possible to continue to give us some more tailwinds into the market. And then for our clients, we've had more bids on the deals that we've been in market with in 24 than in 23. And obviously having more offers can yield a greater outcome with respect to the deal structure, the multiple, the overall value, total lifetime value of a transaction. And the multiples on the deals that we've been under LOI with, and call it the last 18 months or maybe 15 months, from Q1 of this year through 2023, continues to be a really strong figure that, to Kevin's point earlier, that some of the other folks like Brian Kaleo, they're not seeing multiples go up at the greater than $50 million of EBITDA DSO world, but in our space, in the deals that we select to represent, that we're continuing to see multiples go up, which we're never going to be sad about.
Yeah, this is what Brian keeps pressing me on, and others out in the market, buyers in particular, love to have this conversation with us. It's like, look, if we're only worth 12 times, how can I pay 8.59 times for $1 million of EBITDA? And my reaction to that is, we're going to find the right buyer at the right price with the right structure, period. But their point is not a bad one, right? If the private equity companies know that ultimately their terminal value is going to be somewhere at 12, 13, or 12 times, they certainly cannot afford to keep paying these multiples. So right now, clear skies, maybe some clouds on the horizon, but still really able to achieve really nice multiples for folks that we're working with right now.
Yeah, and I mean, to find the right buyer at the right time, some of these buyers can afford to pay more early in their life cycle, of a 5-year life cycle to a recapitalization event, because they see the growth in that business and they know that they've got 4 years to dollar cost average down the multiple they paid on that business, and they see a good pathway forward. Alternatively, if you've got a group that has hit all of the metrics that they wanted to hit and their investment committee is really excited about where the business sits and they want to go to market in, call it, 6 months, well, that presents a very unique window of opportunity for them to go out and stack a couple deals at perhaps above market multiples, because they know that the totality of the business that they're going to be taking to market is attractive and meets all of their internal metrics. So that's just two distinct examples as to why somebody could afford to pay an above market multiple.
Yeah.
But we have worked with over 21 unique buyers in that 15-month period, and 13 of those being first-time buyers of businesses of TUSK. Most of them are, on the younger side, less than 2 years old. Some our clients were that first transaction. So I think that this is a really unique stat, and one that if we close deals with 21 unique buyers, I think you can imagine how many unique buyers we talk to on any given deal. So I think it is important to note, we've discussed legacy DSOs, we've discussed that there are new entrants into the marketplace. And I think it's always nice to touch on the pros and cons of that, because they are very distinctly different, and a lot of meaningful deal points that a client has to weigh when they're going through their decision process of picking which deal makes the most sense for them. But the pros of legacy DSOs are generally they're established infrastructure and support systems in place that allow for our clients to hand off a meaningful amount of administrative burden to these groups in a short amount of time, to free them up to do things that they're more excited about, whether it be more clinical or start a de novo business or go out and help that DSO with mergers and acquisitions, or just spend more time with your family. Whatever it is, having that infrastructure and support is the impetus for why DSOs exist. They are to take burden out of the individual location level and take it to a centralized service and allow the four walls clinically to operate as efficiently as possible, and also benefit from economies of scale. And then you've got track record of recaps. If they've got a couple recaps under their belt, well, that means the likelihood of you getting a return on any rolled equity that you have is much greater. The cons is, if the performance trend is negative, the equity could ultimately end up being less attractive 2 years after you've done a deal with them. And, for every dollar you rolled, it might be worth 75 cents. Because EBITDA was on the decline in the years post-close. So where they're trending matters, and the confidence that you have in them to navigate the tough operational environment that we're facing.
Ryan, this is why it's so important to know, like, who just got a new credit facility, right? Because they went through a quality of earnings on their own. They went through a lot of scrutiny with the lending institution, and that lender decided, hey, we can go ahead and begin lending you a couple $100 million because we believe you're running a smooth, efficient, growth-based business. It's the ones that haven't refreshed their credit facility recently, or aren't close to the finish line in their recap, or aren't in that queue, in that funnel that we talked about, that you got to be worried about, most worried about.
Yep. And then from an operational standpoint, and if they are 300 plus locations, they're going to be a whole lot less nimble than a group that's at 50 locations. And if that's not necessarily a bad thing, if they have really great strategy in place and they're true operationally sound businesses. But that being said, if things really get squirrely, like then it's possible that they're not able to turn that cruise ship around as quickly as they might like in order to address either opportunities or threats into the marketplace. Working with a new DSO, one of the greatest benefits is if you pick the right one, then ground level equity is a great opportunity for you to yield meaningful returns, 3x returns, 300% returns, 400% returns. If you're at that ground level equity, you're one of the first acquisitions that a group does. And then 5 years later, that group goes out and recapitalizes at a great multiple and they do all the things right and everything went swimmingly. You know, there's really no greater economic vehicle that you could ask for. But the difficulty is you don't know who's going to make it. And that's where we come in to make sure that we're doing all the back channel diligence we can and asking all the difficult questions of them that help put you in the greatest likelihood of success if you were to partner with one of these newer groups. But that's true of all groups that we're working with. Built in a difficult environment. So they were formed in an environment with higher interest rates. So as such, their models are going to be very different than the models of a DSO that was formed in 2019 with that interest rate environment. So they're built for a difficult environment and they should be prepared for a higher interest rate environment and their M&A goals that their limited partners and investment committees have committed to are well defined. And if interest rates go down, they're really doing great. Less experienced deal team equal more failed processes. That's where our job is to grease the wheels in those instances and do everything we can, bring in all resources that we can and best practices to help push this thing along to get to close because they're really complex. Every deal is incredibly complex. And when you've got a group that's only done 3 deals to date, the likelihood of them being able to close a deal is significantly less than a group that's done 400 deals. And then, it's possible, it's likely that some of these groups can come in and overpromise and underdeliver with respect to one, the deal terms that they commit to in an LOI, ultimately being the deal terms that get done at the closing table. That's where the term retrade comes in. It's not uncommon for these groups to have to retrade a deal because they just overcommitted. And then once it came down to brass tacks and checks needed to be cut, investment committees got soft on the opportunity for one reason or another, either internally on their side or something that went on in the business of a seller, given they're operating a living, breathing entity. Then just for operations, they might say they've got all these great things and centralized services that they're going to take off of your plate, but then when it actually comes to fruition, it's kind of the Wizard of Oz behind the curtain, and there's not really anything back there to support you. Not to say it's not forthcoming, but they might overpromise on what they've got in the current state.
Yeah, when these private equity companies that are building a new platform, a new DSO, are just getting out of the gate, their first acquisition is it's important, but it's very risky for them. And they're going to turn over every rock and try to identify everything they can. And it's not just the CEO and the head of business development doing that. It's the private equity company that's investing the dollars and the time and the energy. And then finally, it's the lender that's going to fund most or all of the cash at close. So you have layers of diligence and a team that's not accustomed to working with one another. And when you have all that risk on the buy side, you really got to know what you're doing to make sure you can get that thing to close. So it's a riskier experience altogether. It can be a very fruitful experience, but just recognize that the BD person that we're talking with is not the decision maker. The CEO is not the final decision maker. There are a lot of decision makers to get these deals completed.
Yeah, I think that leads nicely into the next section. I know we're a little over for time, so thanks everybody for hanging out with us and getting through here. But we do think it's important to have some pearls of wisdom to share with you all for those that have a longer runway before they're interested in going to market for one reason or another. But this is just really helpful information that we get a lot of questions around. Well, what can I do today to help me get my deal done or help my business appear more attractive when and if I go to market. So we're going to lay out some deal landmines here, and I think the one that we're going to start with is the fastest way to sink a deal is if you're in market with a business and you have associates, meaningful key associates in your business leave, and you don't have a remedy for how you're going to backfill them, that's the fastest way to spook the buy side. So understanding who you have in your organization, if you know it's imminent that you're going to be selling your business one day, I encourage people to consider having an element of their conversation when interviewing them around what is their appetite for ever being a partner. What is their appetite for being a partner if I were to partner with a DSO? Because if it comes down to two candidates and one is a hard no, but you know that the only way to sell your business is to a DSO in 2 years or 4 years or one, you probably should consider the person that comes off as very comfortable working for a DSO or comfortable in your decision making, that you're going to pick a DSO that's going to create a similar environment to that in which they're coming on board to.
Yeah, I just want to add one thing here because we are in market with the deal where it's a multi-location group, many doctors. The owner is a dentist and does not work inside of the business. Yet when we did the practice tour in preparation for the go-to-market strategy, every one of the junior doctor partners was aware of who we were at TUSK and what our mission was for their business. And when we were able to share that with the buy side, they were floored. All too often, associates and junior partners are caught off guard with the sale or the partnership, and it can lead to a lot of headaches and heartburn at the closing table. So the more transparent you can be without hurting the employment opportunity or hurting the business or the production, the better off you are, and the more rewarded you'll be at the closing table.
Yeah, well said. This is something that everybody can work on. Messy accounting and or complex legal structures can certainly hold up a process. Speed is key from the time that you enter the marketplace to the time that you get your deal done. This is not a sprint, but it's kind of a series of sprints. And it's important that we move swiftly through each phase of this deal by also making sure that we don't leave any stone unturned. But, having clean accounting and clean books is helpful in getting deals done quickly. Similarly, having great legal documents, that means lease agreements in place, associate contracts, partner contracts, what have you, having all those things in order really helps speed up the closing process and give buyers confidence in the asset that they're purchasing, which allows them to, quote, apply a lower risk profile to it, to our client's benefit. Real estate issues. So if you got expiring leases or worse than that, a cross-collateralized real estate whereby the practice is the guarantor, that creates a very difficult environment and perhaps some negative implications with respect to the amount of cash at close a client can receive, depending on the relationship or terms that they have with their bank that lended to the real estate. Working with a bad buyer. So going with the first buyer you see, only entertaining one group without getting a broad spectrum. All of these groups, their job is to come off as your friend. It's their job to come off as incredibly excited about the business and incredibly buttoned up, because they're in sales, and we appreciate that. We understand that. We are as well. But if you work with a bad buyer, you might end up 6-7 months into a process before you find out that there's actually no opportunity for you to get a deal done with them. So our job is to make sure that we survey everyone at the same time so that you can run multiple races with minimal effort on your side, because we're doing all the betting.
Ron, I was talking with a couple of buyers this week, and they shared with me that they're seeing deals that they saw before, and when they ask, hey, so what happened here? Why didn't you get your deal done? The answer was, well, I tried to do it myself and I picked the wrong partner, right? So it's like this is not anecdotal. This is real and happening in the market today.
Yep. It kind of leads into this, which is starting a conversation before a buyer, before the business is ready. There are a lot of things that you can say to a buyer that they can use against you throughout the course of their negotiation. And they're not exactly going to outwardly say that in the moment, but they're taking stock on every single word that comes out of your mouth and every single comment you made. And in an effort to come back with that when they have to make perhaps a retrade on the deal, and when you ask why, they give you this litany of things that you've stated that are negative about your business that you might not have known in the moment when you said it. But then they're trying to sell you on why they should pay you less, and they're using your words to do it. So it's important to make sure that you have everything in order before you start a conversation. And it's not uncommon for one of these groups to just say, oh, well, like, I'm in the area for dinner, like, let's just have a conversation. There are a lot of things that can go wrong at that dinner, to your detriment. But all these elements can lead and do lead to retraded or failed deals. And that's what we're here to prevent, is make sure that you take all the time in the world to survey the entirety of the market with as little input or output rather on your side with respect to that process. So these are all, I think, important and hopefully helpful landmines for you all to absorb. But the big takeaways are, the big picture is, hopefully these businesses above $40 million start trading, but there's more deal volume for the sub 40 right now. And we're excited about all the clients that we have in market and all the clients that we plan on getting to market this year about the projected outcomes that we have for them. And certainly feel really great about what can happen to everybody post-election.
Yeah, I would say if you're north of $40 million of EBITDA, sit still. We'll keep you informed. But if you're kind of below that threshold, there are still, especially between $1 and $6 million of EBITDA, there's a ready market for that today.
And we shared all the buyers that are stacking capital right now. I think hopefully see some more of that in, maybe like there's a Fed rate drop. Some of those will come to fruition this year as well. Continue to see that positive trends. We absolutely know of new private equity groups that will get their deal done this year to create new buyers, and that's great to see. And then the structure of these deals. So one, the multiples that we take on any given deal, the range of multiples that we receive on any given deal that we're in market with has never been broader. So that's really meaningful because that's your top line enterprise value number, but also the structures, the anecdote that Kevin mentioned today, it's happening with each and every deal that we take to market. And the devil is in the details, and it's important to put every buyer's feet to the fire around the structure, around the risk sharing, around the upside, et cetera, to make sure that we're creating something that everyone's comfortable with and everybody thinks that we can achieve that second bite of the apple with. So the structure is more important than ever, even though that's something that we've always said. And then when you're ready to exit, let us help you, exit at the top and create that win-win-win. And what we mean by that is, a win for yourself, your family, a win for the new partner that you're partnering with, because you guys are going to be working together for years to come. And then additionally, a win for the patient base that you all are going to be serving together. We truly believe that DSOs should be, they should impact the dental market in a positive way for a lot of different reasons, and improve access to care, and professionalize, what has historically been a cottage industry. So creating that win-win-win is what everybody needs to be focused on.
Awesome. So if you see something you like here, or you're just curious, hey, I wonder what my business is worth today as I'm planning my strategy, and really, it's important to know where you are as you're thinking about where you want to go. We are more than happy to provide you a complimentary evaluation of your group or practice. You can reach out to us at info@tuskpracticesales.com or at the phone number below, 704-302-1043. So reach out to us. We're happy to chat with you about the market or your specific business and give you some guidance on what it might be worth in today's market. Final thing here is we are speaking again at Dykema's Definitive DSO Conference this year back in Denver, Colorado. This is our third year to do a full day workshop on the M&A markets. This year's going to be unique because we're bringing some of the largest DSOs, CEOs to the stage to share with us what their struggles have been. What has it been like if you're north of $40 million of EBITDA, some of whom tried to get a deal done and didn't, some of whom have recently gotten new credit facilities, some of whom have struggled on the business development side, others who have just done remarkably well since COVID even hit. But have a candid conversation with them about what they're seeing, because what they're seeing is going to be driving valuation and operational thinking in that call it $1 to $20 million EBITDA range. So we'd love to have you there. There's a QR code you can scan with your phone and use the code TUSK24, all caps, for $50 off your registration. We'll have former clients there telling their stories, attorneys sharing with you the legal landmines that are out there. And it's really just a fun way to reconnect and really start on a really strong educational footing before the everything that is the Dykema DSO conference. So we'd love to see you join us out there.
Yep. Thanks everybody for sticking with us after we went a little bit long, but we're really excited to get all this information out there as everyone continues to operate their business and kind of plan their own timeline for when is a good time to explore the market. So we're here, we're ready. Take a look at your business anytime. And thanks again for your time this evening.
Thanks, everybody. Thanks, Ron.
Bye-bye.